Welcome to the Rule Classroom. I'm Albert Liu alongside Rick Rule. Welcome to part two of the developer series. Rick, welcome. How are you?
Thank you, Albert. I'm fine.
We're going to continue our discussion today on the developers. And just as a reminder to people, if you missed part one is where we covered many of the fundamentals, including the definition of developer companies, some of the metrics, levels of certainty, the idea of specific expertise, among many other topics. Rick, what are we going to cover right now?
Four things come immediately to mind, Albert, the most important of which is the concept of time in investing around developers. And we're going to spend a lot of time on this. I sort of describe this part of the discussion as compounding versus de-risking, which is to say earlier stage investments, which take a longer time to mature, give you the ability to take advantage of compounding. Investing later in the process de-risks it and moves the net present value closer. So I want to talk about the continuum of time in investing and speculating and the nature of compounding versus de-risking so that people can decide for themselves how to segregate their portfolio along that sort of time continuum. The second thing I'd like to talk about is the methods of achieving value. We're talking about a development process, but the question really becomes, probably at several times during the process, for the shareholders and, of course, for the management team, do they build it or do they sell it? So I want to talk about the difference between building, pretending to build, or de-risking for sale, because these are important considerations that most investors and speculators, in my own mind, don't factor into in terms of their investment calculus. Then I want to talk in fairly technical terms, I'm afraid, about assessing the changing capital stack. Companies maintain different types of balance sheets during different parts of their growth. And I want to talk about the different components of the balance sheet, both with regards to debt and equity, in terms of investing and speculating in these products, and in terms of understanding the risks and the returns on capital employed enjoyed by issuers at various stages in the development process. Finally, of course, in the question and answer session, and I'd like you to help me frame this discussion, probably we need to talk something about pre and post tax. We need to talk about social take, and we need to talk about political risk in the context of pre and post tax and social take. So if you're ready, that's what I'm proposing to talk about today, and in that order.
All right. Before we start, just one thought off the bat, Rick. Are things like develop it, build it, or sell it, are those philosophical things that can be discussed up front? Are those part of the company's mission, or are those things that are decided on a case-by-case basis typically?
I suspect, although I don't know, that these are decisions that change over time. You cannot be aware at the beginning of your mission to discover and then build a mine what commodity prices will be like, what interest rates will be like, what the cost of capital will be like, and ultimately, perhaps, to whom your project might be of more value than it is to you, which is to say, the facts change over time. I have known, certainly, developers who built every asset that they ever built with the view to selling it. I have known other developers who built every asset that they ever built with regards to keeping it. Developers who were honest with themselves understood that the opportunities and the challenges would change over time. And I hope that they're intellectually honest enough and honest enough with their shareholders that their approaches change as the circumstances change.
Okay, thank you for that. Yeah, take it away.
Well, let's start with time. As we talked about before this taping, Albert, in response to questions from the earlier Developers Classroom series, as I become a more experienced investor, and at age 69, I have to say I'm probably pretty experienced by now, that the concept of time has both an economic importance to me and also an intellectual importance to me. As I told you earlier, when I was a young man and I had lots of time on Earth, I was impatient. I learned in 50 years of investing that my time frame was irrelevant, that the time that was required to realize the investment had nothing to do with my time preference and everything to do with the circumstance at hand. And so I've learned to become much more patient, to the extent that now I have much less time on earth and I am much more patient. Not, I think, as a consequence of my own maturity, perhaps that too, but more out of a sense that time is what is required. I think it was Buffett that once said that compounding is the eighth wonder of the world, but it's the first wonder of investing. Allowing your investment to mature, allowing durable competitive advantages to play out in the market is really what fortune building is all about. And in terms of the development investment or the development speculation, I want to talk about a subcomponent of the concept of time, which is to say the value of compounding versus the benefits of de-risking. At the beginning of the exercise, let's say in the context of a developer, at the preliminary economic assessment, PEA study that we talked about in the prior discussion, the amount of time that will be necessary before a mine has been built, and that point in time where a more mature value has been established, you have the ability, through investing early, to compound your money. It is not uncommon for attractive preliminary economic assessment companies with a mineral resource that looks to be viable but hasn't proven to be viable. It's not uncommon for those companies to have market capitalizations in the $50 million range. It is not uncommon for that company 5 years later, 7 years later, 10 years later, upon successful completion of the construction phase, for that same company to have a value at $2 or $3 billion. The idea that you participate in answering unanswered questions, in adding value and de-risking a company, and you enjoy the escalation in a share price of from, say, 50 cents to, let's say, $10 or $12, is very, very pleasant. The prospect of a somewhat de-risked post-exploration investment or speculation activity that can give you a 10-to-1 return or a 15-to-1 return or a 20-to-1 return is extremely attractive. You get the benefit of compounding, which is to say the knowledge that caused you to invest at the preliminary economic assessment stage becomes more valuable at the pre-feasibility stage and more valuable yet at the feasibility stage. On the other hand, you take the risks inherent with de-risking all the way along, which is to say the conclusion that you were able to draw from the preliminary economic assessment may be disproven in the pre-feasibility study or later may be disproven in the feasibility study. So the early investment that gives you the advantage of compounding exposes you to all the risks ironically occurred in de-risking, which is to say very charitably, you could be proven to be wrong. I think it's important for investors who are investing or speculating in the development process to weigh in their own mind the time frame that will be required to generate the returns that are necessary to amortize the risks that they are taking. It is true, in my mind, across all markets, that values improve as certainty improves. So while the publication of a preliminary economic assessment may not result in immediate share price appreciation, it does generally result in more appreciation across a 12-month time frame than would occur in other issuers, irrespective of market conditions. which is to say, as you add certainty, you add market capitalization. You add more market capitalization in good markets than bad markets. But given that you can't forecast with real accuracy what market conditions will be like a year from now or 2 years from now, what you can do is understand that the more information that the market is able to garner, the more value that they can put on that information. What that all means is that a reasonable speculator can anticipate that real value will be added by each of a preliminary economic assessment, a pre-feasibility study, a feasibility study, an announcement of the completion of financing, the announcement of major milestones around construction, and then, of course, the transition from construction to nameplate capacity and operations. And it is a realistic investment strategy followed by many of the most successful investors in the natural resource space to attempt to invest and speculate in what I call catalytic circumstances, which is to say circumstances that involve the acquisition of materially more knowledge around the net present value of a prospect. It's important that investors consider this sort of catalytic increase in knowledge and consider the timelines that are necessary, both in terms of generating this catalytic increase in knowledge, but more particularly with regards to the market's ability to digest it in terms of understanding how they are going to invest in the development space. I point to many development stage investments that I have made, and point to in earlier interviews that you and I have had concerning alpha and beta, about the fact that for my really successful speculations, which is to say my speculations that generated 10-fold returns or 20-fold returns or 50-fold returns, that those investments in almost every circumstance required at least 5 years. And in almost every circumstance, too, generated 50% share price declines during some part of the period of time when I held them. What that means is that the development investor and the development speculator needs to understand the continuum of time, needs to understand the addition of value that can occur over time, and understand, too, that that value that's being generated may not be reflected in the market. So an understanding of those underlying conditions, a patience, and in particular, a persistence and tenacity is required in this process. Increases in value occur by compounding, both in terms of value and knowledge over time. The argument that's made for later stage investing means simply that the time value of money is less. If you are investing later in the development stage, say after the feasibility study has come out, you run less risk of your investment being disproven earlier in the knowledge acquisition program. And of course, you face less discount associated with the time value of money. So it's important when an investor is developing an investment strategy around any category of resource investments that he or she consider time versus de-risking. And in particular, consider investing or speculating in de-risking events that have occurred in very bad markets. It is often the case, Albert, that the value of an asset increases materially, but as a consequence of market conditions, the price of that asset decreases materially. This is the most fun that you can have as an investor or speculator, if you have both the knowledge and the courage to take advantage of that disconnect. The idea that the certainty around a project has increased and its estimated net present value has gone from, say, $100 million to $300 million, But the market capitalization of the company has decreased from, let's say, $150 million to $75 million as a consequence of market conditions. These are actually, while they are psychologically challenging, the best ways to make money in the development space. I hope I've been able to explain to people the necessity of taking into account time, the time value of money, the compounding of both knowledge and capital, and the process of de-risking, because I think it's fundamental to understanding investing in the development space. I also want to leave people with the concept of investing or speculating in catalytic process or progress. I myself will be doing a lot of this in the next 5 years. I intend to, where appropriate, offer capital to small companies to complete preliminary economic assessments, offer capital to small companies to complete pre-feasibility studies, offer capital to companies to complete feasibility studies, and to participate in every layer of the capital stack, which we will talk about later in this discussion. And the idea that our listeners will come to understand the development process well enough that they will understand, first of all, time, but also understand the opportunities that are available in catalytic de-risking along the way, will go a long way to establishing the value that this discussion will have for our audience.
I think one could think of many questions to follow that discussion with Rick, but it seems to me that one that pops out is the various stages at which you can participate. You made a point of saying that a late stage investor would come in after the feasibility study. I imagine like these are very different investment activities, right? Investing before a PEA versus investing after an FS. What can you say about that? Like in terms of the difference of the type of investing, the risk and reward that one would face. There must be strategies, different strategies around different catalytic investments at various stages. Can you somehow give us some orientation and what those are?
There are, and unfortunately, the opportunities change over time. In aggressive markets, people are tending to be more speculative, and they crowd in to the earlier stage, higher risk activities, which is to say, the activities that attract the most market attention become the least attractive as a consequence of the money flying into them. They have the most momentum and the least value. One dichotomy that comes immediately to mind is what's called the build lull. Many companies experience share price declines, sometimes market share price declines, between the time when the feasibility study is published and when construction financing is completed, through construction towards production. This is called by speculators the boring period. The resource or reserve isn't necessarily getting bigger. There's not much to get excited about. The news that you see has to do with the successful completion of a grinding circuit or something. In the Lassonde curve, which is a very famous discussion popularized by Pierre Lassonde around the probabilistic direction of market capitalizations during different times of economic activity, he describes very well the periodic lull that has to do around construction and development. At the same time, our mutual friend Lobo Tigre has talked about what he calls the golden highway, which is to say that if you are willing to endure the boredom for the 18-month or 2-year or 3-year period that accompanies the end of the successful completion of the financing round and construction, that the capital gain that you will generate on the successful completion, which is to say once production is over, nameplate production has been established, and the market can value the de-risked free cash flow, is such that that in itself is an attractive economic activity. Many people who don't have the willingness or the knowledge to absorb the time necessary to participate in Lobo Tigre's Golden Highway fall victim to the boring period in the Lassonde curve. So it's important to have investors familiarize themselves with the opportunities available in every identifiable time set, but to understand that there's no rules locked in stone. There's no rules of thumb. Different parts of the activity become more or less attractive depending on the market's response, the market's condition at that point in time. So it's important that people be conversant with the risks and rewards in the sector, but at the same time be nimble in responding to the market's reaction to them.
You talk about specific expertise. Are these phases of development unique enough that one would invest their time to accumulate specific expertise in a particular stage and then just focus on that?
It can be. I have known people who have been able to do just exactly that. And I think that Lobo Tigre, the early success of his newsletter, The Independent Speculator, had to do with Lobo's willingness to focus on what he called the Golden Highway, the opportunities associated with the boredom that set in as a consequence of the Lassonde curve. There will be periods of time in the market where, perhaps due to the success of one particular investment stratagem, that the opportunity set moves to a different part of the value creation chain. And I would suggest that for most investors and speculators who are interested in the development space rather than the producer space or the exploration space, I think it's incumbent on those people to develop at least a rudimentary understanding of every aspect of that value creation chain that takes place during the development timeline.
All right. Let's move on, Rick. Thank you.
The second discussion is somewhat easier and will take less time. And that has to do with following the progress around decisions about whether to buy versus to sell. A time-honored stratagem, frankly, in mining is to de-risk projects with the view to sell rather than to build. It is true that larger companies can house greater human resources skill sets within the company. They can have a build team in a company at the same time that they can have an operate team in a company. And often smaller companies can't afford the general and administrative expense to have the human resources that are competent in all aspects of value creation. So there are groups of entrepreneurs and company builders who, in fact, take on companies at the preliminary economic assessment stage with the idea that they will de-risk the process through the preliminary economic assessment, through the pre-feasibility study, perhaps all the way to the feasibility study. But they understand that their skill set involves adding value through that process. And then having gotten to the successful completion of the feasibility stage, seek to sell the company to a group of people who have more skills or more access to capital to build it out. I call this the pretending to build process, because if you signal to the market that you're building to sell, the would-be bidders are more inclined to be aggressive with you. If the bidders believe that you have the ability to build it yourself and that you are your own preferred bidder, it's often there is often a shadow bidder in place, which is to say you build this thing yourself. But I think it's necessary for investors to consider Throughout the continuum of the development timeline, the build versus sell technique. If a management team has identified to you that they intend to build this thing and then they intend to operate it, one of the things that you need to do as an investor is assess in your own mind their ability to do both. Have these guys built something before? Have they built something similar before? Do they have the expertise necessary to raise the capital in all capital markets? And having achieved all that, do they have the ability to operate it? A very recent success, Albert, that we enjoyed at Sprott during the time that we were both there was West African Resources, a company that succeeded in discovering a project, completing the preliminary economic assessment, completing the pre-feasibility study, completing the feasibility study, financing the project to completion, despite the fact that they had never done that in Burkina Faso, a frontier market. And now they are extremely successful operators. That transition, that successful transition with one management team across all the aspects of value creation is extremely rare. It is much more likely that the skill sets necessary to discover a deposit are different than the skill sets necessarily to develop it, and that those skill sets are different than the ones necessary to build it, and that those skill sets, in fact, are different than the ones necessary to operate the project. So it's incumbent, I think, on the investors and speculators in the development space to understand something about the build versus sell scenario and how that might change upon the completion of each catalytic milestone in value creation.
Wondering what generally happens to the market cap of the company when the market learns that they plan to build and operate, and what is your initial inclination, your gut? Because you mentioned that the success is very rare. So when you hear that, what is your gut inclination, Rick?
Two things happen. Many investors have a short-term orientation, and they prefer the nearer term exit, which is to say the sell. And the announcement that a company intends to build rather than sell often engenders selling from shareholders who wanted sooner and more certain outcomes. On the other hand, the value that is attained by successful building, although it takes longer, is often higher if the team associated with the build has the capability of carrying it off. When I look at the very successful private merchant banks, the often family groups associated with adding value in mining, when I look as an example at Ross Beaty's ability over time to add value, or the Lundin family's ability to add value over time, these guys were people who were completely willing to sell if the market offered them a fair risk-adjusted price for the assets that they were selling. But they also developed the capabilities internally that their threat to build was a credible threat, because they brought in projects on time, on budget, generated successful completion, and after they generated successful completion, were able to operate those companies successfully. It's worthy to note that there are very few Ross Beatty's and very few Lundins out there in the world. One example that comes to mind might be Clive Johnson around the BEMA and then B2 group, who was similarly successful in acquiring, building, and operating deposits. But I suggest that the shortage of people involved in that speaks a lot to what is available. And I would say, too, in terms of this discussion, which is a discussion of developers, that when you are looking at developers, you are by necessity probably excluding companies that are already producers that have to be looked at in a different light. The discussion of the people who have integrated capabilities should probably be limited to those listed issuers in their group who are involved primarily in what are now development activities.
Okay, Rick, just a minute or two left, so we're going to have to continue this at the next session. But any parting words for the viewers?
No, I apologize for the fairly dense nature of today's discussion. But I think that the Rule Classroom is not meant to be a cursory overview, but rather it's meant to give serious investors and serious speculators the tools to make serious money in all market conditions. And that can't be done, I'm afraid, without a fairly deep, fairly technical dive into the circumstances that can allow you to reasonably expect to make money.
Right. And it's consistent with the lesson of today, which is low time preference is what you need. In this case, we're compounding knowledge, but I think patience yields dividends. So thank you, Rick. I look forward to our next session. Thank you very much. I speak on behalf of everyone. I think we really appreciate you doing this.
Albert, thank you so much for bringing this classroom series to life. I particularly look forward to seeing the questions and discussions on social media after this comes live. It gives me the sense that you and I are generating in the minds of our audience real value.
I agree. Thanks again, Rick. We'll see you soon.
Thank you.